welcome and good morning to our lecturer and friend. Today we want to present about insider trading and limit up and limit down. Yes. Okay. First of all, let me introduce myself and our team member. My name is Muhammad Fijabi.
And my name is Muhammad Hasib Asadi Bezarudin.
My name is Muhammad Idris.
My name is Muhammad Azim.
And my name is Nurfazana.
Okay, first of all, I want to explain to you all about a case overview. For this slide, I will explain the overall background of the company involved in this case. Perak Corporation Berhad, also known as PCB, is a state-linked company. This means the company is owned by the Perak state government through an agency called Perbadanan Kemajuan Negeri Perak (PKNP), because PCB is connected to the government. It has a higher responsibility to operate in a transparent, ethical and accountable manner. PCB is involved in property development, industrial project and investment activity in the state of Perak. This project contribute to economic development and public wealth. Therefore, any misconduct within PCB does not only affect investors but can also affect public confidence in government-linked companies. This case focused on a very serious issue, which is insider trading. The misconduct involved top management, which make the issue more serious because senior leaders are expected to set a good example. This case is important because it shows how abuse of confidential information by people in power can hurt, like investor, market integrity, public trust. Okay, next I will explain to you about background of the case. Before any manipulation occurred, PCB was operating normally. There was no major announcement made to the public, and investors believed that the company's situation was stable. At the same time, there were internal discussions happening between PCB and PKNP regarding purpose privatization of PCB. Privatization is a major corporate decision that usually lead to change in ownership structure and can significantly affect share price. This information was confidential and was not shared with the public. Only selected individuals and the top management level were aware of this discussion. This kind of information is called material non-public information. It is very important because once it's become public, it can influence investor decision and cause change in the market price of share. Because the information was highly sensitive, it should have been protected and not used for personal benefit. Okay, next I will brief case summary. The CEO of PKNP and PCB had direct access to this confidential information about the purpose privatization. As the senior executive, he had a legal and ethical duty to keep this information confidential. However, instead of protecting the information he used is for personal gains, while the privatization plan was still confidential, he purchased a large number of PCB shares. These purchases were made before the information was announced to the public. After this privatization plan became public, the share price increased, allowing him to benefit financially. This action gave him an unfair advantage over ordinary investors who did not have access to the same information. As a result, the Security Commission Malaysia investigated the case and concluded that the conduct was insider trading, which is illegal under Malaysian security law. This slide focuses on explain insider trading in more detail. Insider trading occurs when a person buy or sell share using material non-public information. This type of behavior is considered unethical and illegal because it violates the principle of the fair and transparent market. In this case, the insider had information about the privatization plan, which was likely to increase PCB share price by trading before the announcement. The insider gains profit that were not available to the public. This type of misconduct is create inequality in the market, harm small and retail investors, reduce confidence in the stock exchange. Because of this negative effect, insider trading is strictly prohibited to punishable by law. Finally, I will explain why this case is important and what we can learn from it. This case highlights the importance of ethical leadership and good corporate governance, especially in government-linked companies. When senior managers abuse their position, it damages investors will confidence, public trust in government institutions, the incredible of the financial market. This case also shows why regulatory bodies like the Security Commission Malaysia play a crucial role in monitoring and enforcing market rules. In conclusion, the PCB insider trading case serves as a strong reminder. Confidential information must be protected. All investors must be treated fairly. No individual is above the law. This case helps us understand the serious consequences of insider trading and the importance of maintaining integrity in financial market. That's all for me. I will pass to Dana.
Okay, so for this slide, I will explain about the legal action and court judgment that related to this case. So in December 2021, the Securities Commission initiated a civil actions after identifying suspicious trading activities. And then after a long investigation process, the case was brought up to the High Court. And then in February 2024, the High Court ruled in favor of the Securities Commission. The court actually confirmed that insider trading had occurred under the Capital Market and Services Act of 2007. So this judgment shows that insider trading is a serious offence and that authorities will take firm actions to protect market integrity. Moving on to the penalty imposed by the court. So actually the individual involved was ordered to pay RM 2.46 million disgorgement, which is 3 times the illegal profit that they earn. And then this is meant to ensure that offenders do not benefit anything from the illegal activities. In addition, a civil penalty of Rm 1 million ringgit was imposed as a strong deterrent against future misconduct. The court also actually ordered Rm 100,000 ringgit to be paid for the cover of the investigation and legal costs. Furthermore, the offender was banned for 5 years from holding director or CEO positions and from trading on Bursa Malaysia, which reflects the seriousness of the offence that happens. So for the early warning signals that pointed towards the insider trading, there were unusually large share acquisition made by corporate insider. The buying activities continue over a period of time even though there were no public announcement made to the investors involved. More importantly, the timing of these trades closely match internal privatization discussions within the company only. When these signals are viewed together, they strongly suggest the misuse of confidential insider information. So this is the chart of the abnormalities, price behavior. So the share price show a strong upward trend forming higher high and higher lows. However, the price increased very rapidly without any clear public news or announcement to justify the movements. Such sharp price movements are considered abnormal in the market industries. This suggests that certain investors may have acted on insider information before it became available to the public. So for chart abnormalities and volume behavior, during the same period, trading volume increased significantly and remained unusually high. There was continuous buying activities despite the absence of public information. This abnormal volume pattern supports the suspicious raised earlier from the price movement. Together, the abnormal price and volume behavior often indicate possible market manipulation and insider trading. This slide shows sharp reversal after the peak. After hitting a high point, the share price declined sharply in a short period of time. There was no proper consolidation or distribution phase before the drop. This pattern suggests that dominant or informed players exited their positions earlier. As a result, retail investors who has entered the market late were left holding losses. This highlights the risk faced by retail investors when insiders trading occurs. Okay, so now what retail investors should have noticed the technical indicator. Firstly, the MACD indicators show a bearish crossover, which signal weakening upward momentum and a possible trend reversal. Secondly, the RSI show bearish divergence and later fell below the level of 50, indicating that buying trend was decreasing. Lastly, the volume pattern changed accumulation to distribution, meaning large players were starting to sell rather than buy. When these indicators are seen together, they act as a warning signs that the price may decline and that risks in the stock were increasing. So, for this slide, I will explain about the candlesticks and market behavior signals. Firstly, rejection wicks appear near resistance level, showing that price were repeatedly pushed down by sellers. Secondly, bearish engulfing patterns form, which signal a shift in the market sentiment from bullish to bearish. And lastly, the price tested supports level multiple times, indicating increasing selling pressure. So together, these candlesticks pattern suggested that the market was weakening, that a price decline was likely.
So for the next, I will explain why the stock was easily manipulated. So for this slide, we focus on why this particular stock was highly vulnerable to manipulation compared to other stocks in the market. Firstly, the stock had very low liquidity, meaning it was not actively traded on a daily basis. When a stock has low liquidity, there are fewer buyers and sellers in the market. As a result, even small trades can cause large price movement, which makes the stock extremely sensitive to manipulation. And secondly, the company had a low free float, which means only a small proportion of its total shares were available for public trading. When most shares are concentrated in the hands of few parties, it becomes much easier for those parties to control supply and influence price movement. And thirdly, there was limited analyst coverage and professional scrutiny. Without continuous monitoring by analysts or institutional investors, unusual trading patterns may not be detected clearly, allowing manipulation to continue for a longer period. And finally, the stock was highly driven by rumors and market sentiment rather than strong fundamentals. In such situations, investors often react emotionally, making decisions based on speculation rather than analysis, which further increase the stock's vulnerability.
Right, next.
How these factors enable manipulation? These structural weaknesses directly enable the manipulation to take place and persist over time. Because of the stock's low liquidity, manipulators only needed a relatively small amount of capital to push price upward, creating the illusion of strong demand in the market. With a limited free float, controlling a small number of shares allows dominant players to artificially influence supply and demand, making price movement appear natural when they were not. At the same time, the lack of transparency and professional oversight meant that abnormal trading activities were not questioned early, giving manipulators more time to build positions. Additionally, emotional retail investor behavior, such as fear of missing out, play a significant role. As price rose, more investors rushed in, further amplifying the price movement and unknowingly supporting the manipulation.
Right, next.
Relevant CMSA 2007 provisions. From a legal perspective, this case involves serious violation of the Capital Markets and Services Act 2007. Firstly, Section 1882A clearly prohibits insider trading based on material, non-public information. In this case, the privatization discussions were confidential and highly price sensitive. Yet, trading occurred before the information was disclosed to the public. And secondly, Section 177 addressed breach of fiduciary duty. As a CEO, the individual had both a legal, ethical obligation to act in the best interest of the company and its shareholders, rather than using inside information for personal gain. And thirdly, Section 1882B relates to the failure to disclose material information before trading securities. Together, this provision exists to ensure fairness, transparency, and equal access to information for all market participants.
Right, next.
Effectiveness of regulatory action. This case demonstrates the effectiveness and importance of regulatory enforcement in maintaining market integrity. The Securities Commission Malaysia pursued that the case despite the senior position of individual involved, demonstrating the enforcement is applied consistently and without favoritism. The penalties imposed were significant and designed not only to push but also to defer future misconduct. And more importantly, the High Court ruling reinforced the principle that no individual is above the law, regardless of influence or authority. Overall, this regulatory action play a critical role in restoring investor confidence and strengthening trust in the Malaysian capital market.
Right. Next slide.
So, second slide is the victims of the case. The impact of insider trading extends beyond the offender and affects multiple stakeholders. The primary victims were retail investors who purchased shares at artificially inflated price and suffered losses when price eventually declined. Long-term shareholders were also harmed as extreme price volatility disrupted the stock's fundamental value. Employees of the company became indirect victims as reputational damage could affect company stability, future growth and job security. And lastly, the case damaged the credibility and integrity of the capital market, weakening public trust in fair and transparent trading. Next is the lesson for retail investors. This case offers several important lessons for retail investors. First, investors should avoid chasing price without confirmed public information. Price increases alone do not necessarily reflect genuine company value. And second, paying attention to technical indicators such as volume, MACD and RSI can help identify early warning signals before major reversals occur. Third, investors should exercise caution when investing in low liquidity and rumor-driven stocks, as these stocks are more easily manipulated. Ultimately, successful investing depends on discipline, risk management and emotional control rather than speculation or hype.
Alright, so
Next. So, for the personal reflection, what I learned from this case is that having power and access to information should be treated as responsibility and not a privilege.
Okay, what I learned from this case is that the individual involved did not commit the offence because of a lack of rules, but because of a lack of self-restraint. So, I think so. This is the personal reflection. Especially the retail investors must remain disciplined and informed at all times. So, I think that's it, guys. That's it. That's the presentation. Want to talk something? Alright.
So what that I learned from this case is, this case also taught me that simply knowing the law is not enough if we don't know the technical.
Yes.
But insider trading regulation yet still choose to proceed. They fully aware about the insider trading regulation, but they still proceed to do it.
Alright. Understand. Alright. Okay, we proceed to the next chapter, which is limit up and limit down. So this is the crisis that happens in Bursa Malaysia, which is the Bursa Malaysia limit down crisis. It is happened in January 2024. Okay. In that case, there are 3 companies that have been hit by limit down. So without further ado, let's go to the next page. Right, thank you, Dana. So I'm going to put my phone here. So this is the company background, which is the Rapid Synergy, YMS Property and SAIB. So the first, Rapid Synergy Berhad, it is operates in 2 segments: precision tooling, whether it's manufacturing for the semiconductor industry, and also investment holding, commercial and industrial properties. The next one is YMS Property Berhad. The business model is prominent property, developer focus on townships in Perak and high-end projects in the Klang Valley. So the things that they do is Kiara 163 and also Solastar Dutamas. The last one is SCIB, Sarawak Consolidated Industries Berhad. Please don't laugh. Alright. Business model is the largest precast concrete and industrialized building system. IBS manufactured in East. In East Malaysia, primarily involved in civil engineering and construction. Alright. So this is the crisis, but this is before the crisis happened, which is the pre-crisis context. This is the I'm sorry. So this is the speculative rally phase. Okay, so what is speculative rally phase? Speculative rally is like the company follow the extreme momentum, but not the fundamentals. You know, fundamentals like basics in investment. So you must follow the basic first. So but they follow the extreme momentum. So that's what happened on the company. Okay, so this is the first company, Rapid Synergy. As you can see, the share price surged from 6 ringgit to 29 ringgit 50 cents. So it is unexpectedly doesn't make sense, right? Because it nearly gains 400%, and despite declining revenues, it traded an extreme PE ratio of 600 times for exceeding industry norms. That means exceeding means that this company price exceed more than others industry. So yeah, it doesn't make sense, right? Because in Bursa Malaysia rules or legal, only 4% or 6% price can increase, right? Okay. So the next one is YNH Property. The share price double, reaching over 4 ringgit, even though the company had been reporting net losses since 2020. So as you can see, the company net losses, they got the net losses, but the price has been double, reaching over 4 ringgit. And the last one is SCIB. Yeah, it experienced a retail rally. So what is retail rally? Retail rally is like promo, market promo like that. So the price in the Bursa market increase. So it's like they know the price will increase. So that is retail rally, as you can understand. So it gaining 35% in value just months before the crash, fueled by optimism over Sarawak's infrastructure projects. So the next one. So this is the red flags. Okay, the red flag, the bad things. As you can see, okay, that's the red flags. Okay, in the Finance 346, financial and governance red flag. As you can see, the YNH company, high debt levels. The company YNH was heavily hit with over 500 million in short-term debt. Like how much debt, how much loan that they will make, but it against only 17 million in cash. So when you see at the back, right, in YNH company, the share price, you know, the company had been reporting net losses, and then they are making a loan in short-term debts like 500 million. That's so many, right? So that's the red flags you can see in the company. And the next one is auditor's concern. In May 2023, YNH company received a qualified opinion from auditors regarding unverified joint venture, payment signaling, and internal control issue. So as you can see, the qualified opinion, you think that the company is being qualified in the Bursa Malaysia, right? But in this case, qualified opinion is like right, wait. It's like I can't remember. Alright. It is not a clean company because there are unverified joint ventures, payment and signaling internal control issues. So that's the red flags on the company. So the next one is concentrated ownership. All three companies were heavily influenced by a small group of substantial shareholders, notably Datuk Dr. Yu Kuan Chun. He creating the high key man risk. Yes. So the next one. So this is the market environment. The paper wealth bubbles. market capital for this firm, this multi-year highs, they were not supported by cash flow or profit margin. That means that the market capitalization has been increased. The price on the market has been increased, but it is not supported by the cash flow or profit margin. And the next one is margin trading exposure. A high percentage of retail and institutional holding were tied to margin facilities. Margin, okay, what is margin facility? Margin facilities is like a brokerage apps who give you more money to lend for you to invest more or trade more in the market. So that is margin facility, trading on credit, like a lend money. Okay. So making the stocks highly sensitive to even minor price drop. So alright, I think what's next? Okay, what's next? Things that happen is what happened when the current crisis happens, where so this is what happened after this. Yes, this is what happened when the I think I'm going to pass to my best buddy Afiq to present. Right.
Good day everyone. Today I will be explaining about how the market crashed by stages. At first, they lost confidence. Followed by widespread panic, and ending with a pressure selling, shares selling. So this is very important. Our case is very important because it shows how leverage, fear, and market structure can give a big impact to the market shares, because without any major negative news at the beginning. So first, the initial spot, January 9 until January 16, 2024. What happening is there is one tycoon named Dr. Yu Kuan Chuan. His specific shares price decreased little by little. At first it looks like nothing serious, but day by day Bursa Malaysia noticed unusual trading activity, and then straight away call the company that shares Dr. Yu Kuan Chuan shares. They called the companies, and unfortunately the company says that we are not aware of any unusual activities. So what happened next is the investors are all confused. Why they are confused? Because the price was falling down, but there is no clear explanation. They don't know why the price is falling down. So they are confused. When they are confused, the confidence, they lost their confidence.
Yes.
So when people lost their confidence, they will straight away sell their shares without hesitation. They will keep selling the shares to avoid a bigger loss. So that.
Alright.
Okay, we start with panic spreads. What is panic spread? Okay, what happened is when the price of the stocks fell, the fear spread to the other stocks. So when the fear spread to the other stocks, even companies that are not related also were also affected. So what happened is investors don't want to buy any stock because they want to avoid a bigger loss. So at this point, everyone is selling their shares not because yes. They are selling their shares because of their fear, not because the company is doing badly. Okay, next we go to liquidity freeze. Liquidity freeze is when the stocks fell at the maximum limit down, and it also called as liquidity freeze. At this point where everyone want to sell but no one want to buy, so what happened was the market freeze. When the market is freeze, yes, investor will start trapped in their position. They cannot sell their shares even though if they want to. Okay, the trigger, margin calls and forced selling. Okay, the vicious cycle, as prices fell slightly, investors who bought these shares on credit were hit with margin calls. I will explain to all of you what is margin calls. Okay, automatic liquidations. When investors could not provide more cash, brokerage automatically sold their shares at any price. This forced selling drove prices even lower, triggering more margin calls for another investors. So the result is this created a downward spiral where the selling became mechanical and uncontrollable. So I will explain to all of you what is happening now. Okay, it all starts with margin trading. What is margin trading? Margin trading is when you buy a share using borrowed money from a broker. Yeah. So and the best part is when the price keep falling sharply. So the brokerage will ask you to add more money and buy more shares. But of course, most of the investors couldn't provide more cash in time. So what the brokerage do is they automatically sold all the shares, no matter how low is the price was. When the broker asks the investor to add more money, this request is called a margin call. So when the broker sell their shares automatically without any concern of the investor, that is called forced selling. Yes. So when forced selling cause price to fall even more. Yes. Alright. So to conclude, lower prices, when the prices is low, it will cause more margin calls and the cycle will continue.
So I will be presenting on the topic regulatory response and containing the contagion. This presentation explains how regulators in Malaysia reacted to a sudden stock market crisis and how they managed to stop panic from spreading. First, I want to explain the word contagion. Contagion means when the problem is one of part of the market spreads to the other parts, just like a disease. In the stock market, contagion happens when investors see prices falling, become afraid and start selling their shares. When many people sell at the same time, prices fall even more and the panic strikes quickly. In early 2024, several mid and small cap stocks in Malaysia experienced very sharp price drop. This caused fear among investors, especially retail investors. People started worried that the entire market was collapsing. Because of this situation, Bursa Malaysia and the Securities Commission of Malaysia stepped in. Their main role was to protect investors and maintain market stability. The regulatory response can be divided into three main stages. First, immediate defensive measures. Second, restoring market confidence, and third is long-term policy evolution. I will now explain each stage in detail. Next. So the first stage is called immediate defensive measures. These are actions taken very quickly to stop panic and prevent the situation from becoming worse. Suspension of intraday short selling (IDSS) is short selling is a trading activity where investors make money when prices fall. In normal conditions, short selling can help market efficiency. However, during a crisis, short selling can increase fear and push prices down faster. During the crisis, Bursa Malaysia decided to suspend IDSS for the most volatile stocks, such as SCIB, Dental and Tenco. The purpose of this action was to stop traders from taking advantage of falling prices, to reduce selling pressure, and to slow down the sharp decline in share prices. By suspending IDSS, Bursa Malaysia reduced negative trading behavior and gave the market time to stabilize. This action showed that the regulator was actively protecting the market and not just observing the situation. And this is unusual market activity inquiries or UMA. The next defensive measure was issuing unusual market activity or UMA queries. A UMA query is a formal question sent by the regulator to a company when its share price moves abnormally, either up or down. Companies such as YNH Property and Rapid Synergy received UMA queries. These companies were required to publicly explain whether there were any undisclosed corporate development, confirm if there were internal problems causing the price crash. This is important because it increases transparency, it reduces rumors and speculation, and it gives investors reliable information. When investors receive clear information, they are less likely to panic and sell emotionally. So this is trading HOTS and the limit down mechanism. Another important defensive action was the use of trading HOTS. In Bursa Malaysia, when the stock price falls by 30% in one day, it reaches the limit down level. At this point, trading is temporarily stopped. This trading allows investors to calm down, time to think, analyze the situation, and the market to cool off. Without trading HOTS, investors may panic and sell immediately, which can cause a total market crash. So trading HOTS can act like a safety brake in the market. So importance of immediate defensive measures. These immediate actions were very important because they stopped panic from spreading, protected small investors, prevented manipulation and forced selling, maintained short-term market stability. Without these measures, the crisis should have spread to the entire Malaysian stock market. Next. So this is restoring market confidence and Securities Commission and Bursa. After controlling the panic, the next step was to restore the market confidence. Confidence is very important because the stock market depends on trust. If investors lose trust, they will stop investing. Because the joint assurance statement. On 19 January 2024, the Securities Commission and Bursa Malaysia released a joint assurance statement. This is a rare action which shows how serious the situation was. This means the Malaysian economy is still strong. The crisis was not a sign of economic collapse and the problem was limited to certain stocks. The statement helped calm investors and reduce fear. Number 2 is isolating the risk. Regulators also explained that only a small group of mid to small cap stocks were affected and these stocks represented only 0.17% of total market capitalization. This explanation helped investors understand that the problem was small, large companies were still stable, and the overall economy was not affected. By isolating the risk, regulators stopped panic from spreading to healthy companies. And number 3 is increased surveillance and monitoring. The Securities Commission increased real-time surveillance of clearing houses and stockbroking firms. One major concern was margin calls. Margin calls force investors to sell shares quickly. If too many investors are forced to sell, it can create another wave of panic. By monitoring closely, regulators ensured that brokers did not default, the financial system remained stable, and the market continued functioning smoothly. Next. After handling the crisis, this is number 3, long-term policy evolution. After handling the crisis, regulators focus on long-term improvement to prevent similar problems in the future. So, first there was introduction of trading reminders. In May 2024, Bursa Malaysia introduced a new feature called trading reminders. These reminders warn investors that certain stocks remain highly volatile. Even after Umar queries have been answered, this helps investors to be more careful, avoid emotional trading, and make informed decisions. So, next is enhanced surveillance using technology. The Securities Commission also improved its system by using artificial intelligence or AI and advanced data analytics. So, this will help to detect false selling patterns, market manipulation, and early signs of market stress. This shows that the regulators are learning from the crisis and improving future protection. So, for the conclusion, Malaysian regulators responded quickly, clearly, and effectively to a market risk crisis. They took immediate action to stop panic, restore confidence through clear communication, and improve long-term market regulation. This action helped protect investors and maintain stability in the Malaysian stock market.
Alright, next. So I'm going to explain about the charts. So as you see, I'm drawing the chart about the selling price analysis. Alright, so the October to December 2023, the sudden price spike, like as you can see here, the price hit the ceiling. Okay, the price hit the ceiling in December 2023. So it has been recorded by the company SCIB or Rapid Synergy, where there are 300%, 600% price increase. So as you can see here, it almost increased 30 ringgit. So yeah, that's 300% or 600% before the price. Right. So the next one is volume explosion that January 17, 2024. Okay, 2024. As you can see here, in January 2024, the price has went down like this. So this is the limit down. So this is what the limit down, how the limit down happens. Yes. And yeah, like in this January 17, 2024, the SCIP company has been recorded over the most active person who sells the shares. Alright, like almost 250 million, because the price has been spiked down like this. So this is the limit down. So this is the sharp reversal after operate the exit January 24. So this is what happened when the people start to force sell. Alright, force sell, because so the investor start to panic. So this is where the investor starts to panic because of the limit down. So right now, I think you guys understand, right? What I'm explaining. So without further ado, let's go to the next page. Right, so this is the typical lessons for the retail investor. Okay, next. So the first one is the investors must avoid the fundamental price disconnect. So in reality, 2024 crisis, 2024 limit down crisis, share price of stocks like Rapid Synergy and Imasco grew by 200 and 600%, while their business profit were flat or negative. So how the company grew by 200% and 600%? So yeah. Then the next one is the lesson. When the stock price moves astronomically without a corresponding rise in revenue or profit, it is a speculative bubble. So speculative bubble is like the same. It's almost the same like speculative rally, whether which is the it is like you go for extreme momentum but not the fundamentals. You not follow the basic of investment. Yeah, that's the lesson. So the actions: prioritize company with consistent cash flows and economic modes over those driven solely by market rumors or momentum. So don't follow the rumors or momentum. Be the fundamentals. Go basics. Right? Go basic point. Okay. Next one is project concept. So the reality, the limit down spiral was accelerated by margin call. Investors who traded on credit were forced to sell. Okay, forced to sell because the broker forced them to sell. Destroying their capital instantly when they couldn't top up their account. But right, because they couldn't top up their account, so they are being forced to sell. Alright, the lesson: leverage acts as a double edged sword. It magnifies gains but makes you a forced seller during crash. So yeah, broker force you to sell your shares during a crash. And the action: limit the use of margin facilities, especially on high beta small cap stocks. Follow the 2% rule. Never risk more than 2% of your total capital on a single speculative position. So that means that don't take so much risk without further information. Alright, next one. Don't laugh. Okay. So the last one is respect the red flags and market integrity, the reality. So the audit has been known the crisis before the crisis happened, because qualified opinion, right? I'm telling you about the qualified opinion that the company is not clean. If the company is unqualified opinion, the company is clean. But in reality, audit reflect like when there's company qualified opinion and high key main risk, like Datuk you want Dr. George. Alright, so and high key main risk, heavy reliance on a single tycoon were visible months before the collapse. So we predicted before the crisis happened. And the lesson, so the action, the lesson first. The market rarely crashes without warning signs. So it crashed, but without the warning signs. So that's why the investors is panicking. So they panic and they went to be forced seller, sell anything in the on their shares. Alright. Sorry for mumbling. Lack of transparency in corporate governance is often the first sign of coming liquidity crisis. And the action: diversify across different sectors, to protect against unsystematitis company-specific failure. If a company receives multiple UFA questions or auditor warning, it is time to reassess your exit strategy rather than buying the dip. So be careful when buying something in the market. Alright? So this is the reflection. On our reflection is the 2020-24 crisis was a reminder that liquidity is a coward. It disappears exactly when you need it most. Alright? A stock that is easy to buy during a rally can become impossible to sell during a crash. True wealth is built on companies that can survive the limit down because their value is in their asset and profit, not just their ticker symbol. So, success in the Malaysian market is not about finding the next 600 yen, but it is about surviving the 80% losers. Protecting your capital through diversification and fundamental research is the only way to stay in this game. So I think that's the question. That's the sorry. Thank you. Right. Sorry. Bumping.